Welcome to the Deep Dive. Today, we're cracking open a set of documents that are probably the closest thing we have to a real-time economic forecast for the next decade.
Yeah, that's a good way to put it.
We're doing a deep dive into the Q3 fiscal year 2026 Form 10Q and the investor presentation from, well, the company that's setting the pace for the entire AI industry right now.
And these reports, they're so much more than just a quarterly update. They give you a look under the hood that, you just don't get anywhere else.
Right.
We're talking about the financial scale, the huge strategic bets, and the very real risks involved in shifting the whole global economy to this accelerated computing model.
So our mission today is to unpack the most important stuff here. We want to get past the headline numbers and really understand the architectural shifts and, the geopolitical pressures shaping all this.
Exactly. And the foundational takeaway, the big idea, is that this company sees itself building the infrastructure for three huge platform shifts, all happening at the same time.
Okay, let's break that down.
So first is accelerated computing. That's the obvious one. Second, these powerful, massive AI models.
Right.
But the third one, and this is a key strategic nugget right from their report, is the rise of what they call agentic applications.
That's a term we hear a lot in these reports. For anyone listening, what does that actually mean in practice, and why is it so important for the financials right now?
It's the jump from AI that just answers your questions to AI that can, actually do things.
Take action.
Exactly. Think about an agent that can book a complex trip for you, manage your entire calendar, or even autonomously optimize a factory supply chain. That kinds of real-world action takes just a staggering amount of compute.
And not just compute, I assume.
No, and this is the key. It requires staggering amounts of high-speed communication between the chips because these agents, they run on these vast interconnected clusters. This shift is what justifies the massive, massive spending on their networking gear, which we'll definitely get into.
Okay, and the financial scale they're operating at to support all this is, well, it's hard to believe. So let's start with the top line. Total Q3 revenue hit an absolutely stunning $57 billion.
To put that number in perspective for a second, it's not just the total, it's the growth. That's up 62% from the $35.1 billion they did in the same quarter last year.
Just an explosion of revenue.
It is. And what really shocked analysts was the speed of that acceleration. They actually highlighted achieving a record sequential revenue growth of $10 billion in one quarter.
Wow.
This isn't just growth. It's a parabolic ramp up.
Now, that kind of top-line growth usually means you get incredible operating leverage, right? Where the bottom line should rocket up even faster.
You'd think so.
But net income was up 65% year over year, which is amazing, don't get me wrong, but it's only a little faster than revenue growth. It came in at $31.9 billion. So why isn't that gap wider? What's eating into the margins?
That is a really sharp question. And the answer points directly to the intense, non-negotiable costs of doing all this. I mean, their earnings per share, $1.30, up 67%, and their operating income, $36 billion, up 65%. They look fantastic.
They do.
But there are two huge drains on that profitability. First, the cost of managing this massive supply chain transition. And second, honestly, the cost of geopolitics. They are carrying billions in write-offs because of sudden export control changes.
So they're spending a fortune just to keep up with their own demand.
They're building the plane while flying it at supersonic speed. Exactly.
And there's one clear engine driving all of this momentum, and that's the data center segment.
Oh, absolutely. The data center segment is the entire story here. It brought in $51.2 billion in revenue for Q3. That's a 66% jump from last year.
So basically 9 out of every $10 they make.
That's it. It's all about selling and connecting AI infrastructure.
And when you dig into that data center number, that's where you find the real architectural clue, I think. Compute revenue was huge, $43 billion, up 56%.
Massive.
But the supporting player, networking, is just undergoing a revolution.
Okay, this is where it gets really critical. Networking revenue hit $8.2 billion.
That's a 162% increase year over year.
Staggering, isn't it? This isn't just about selling chips anymore. This is about selling the entire high-speed nervous system that you need to build these AI factories.
162%. What's the specific driver for that kind of monumental acceleration?
It goes right back to what we were saying about agentic applications and the scale of the new models. The growth is coming from their proprietary NVLink compute fabric. That's the plumbing that connects all their new systems, plus XDR InfiniBand and high-speed Ethernet.
So you can have the best chip in the world.
But if you can't connect thousands of them together so they can talk instantly, the whole system just grinds to a halt. They're selling the specialized high-bandwidth highways between all the processing towns they built.
That explanation of the fabric really brings us to the product transition that everyone's watching.
Yeah.
The move to Blackwell.
Correct. And that shift is moving aggressively from the older Hopper systems right into what they call Blackwell full-scale data center solutions.
And it's happening fast.
Way faster than people thought. The presentation emphasized that Blackwell Ultra is already the leading architecture across all their customer categories. The transition is well underway.
And what's wild is how that demand has given them this unprecedented visibility into their future revenue. We're talking $500 billion.
It is jaw-dropping. They reported having visibility into $500 billion of Blackwell and Rubin revenue from the start of this fiscal year through the end of calendar 2026.
$500 billion.
That level of forward guidance, it just fundamentally changes the business. They're not a cyclical chip company anymore. They're a high-visibility, committed infrastructure provider. It lets them demand capacity guarantees from their suppliers and basically de-risk their own spending.
But that $500 billion in commitments brings up the other side of the coin. Massive customer concentration risk. Who is actually locking up all this future demand?
The 10Q spells it out very clearly. 4 direct customers made up sales of more than 10% of total revenue in Q3. You have customer A at 22%,
Wow.
customer B at 15%, C at 13%, and D at 11%. And all of that is tied directly to this high-value compute and networking segment.
So if customer A, at 22% of your revenue, decides to delay a big data center build, what does that do to the whole system?
That's the multi-billion-dollar question, isn't it? A delay from just one of them could shatter their short-term guidance and send ripples through the entire supply chain. Now, the long-term contracts help mitigate that, but the risk is definitely there.
And the demand isn't just direct, right? The documents hint at another layer underneath all this.
Exactly. The report estimates that one unnamed major AI research company contributed a meaningful amount of revenue, not by buying directly, but by buying cloud services from this company's customers.
So it shows their product is essential no matter where you sit in the value chain.
Whether you're the cloud provider or the AI developer using that cloud. Yes.
Okay, let's pivot now. Let's talk about the friction this scale creates. Despite all this success, you mentioned that GAAP gross margin actually dipped a bit year over year. It went from about 74.6% down to 73.4%.
And that little dip is, it's the cost of war, the operational war to win this market. It's the direct result of the complexity of shifting your entire global production from Hopper to Blackwell.
Right.
When you're forcing your own high-margin product into obsolescence to replace it with a new one that needs this incredible supply chain coordination, your transition costs are going to temporarily eat into that margin.
But the single most visceral example of this friction has to be that inventory charge. The one tied to geopolitics.
Yeah.
A $4.5 billion write-off.
Absolutely. The documents show that in the first 9 months of the fiscal year, there was a shocking $4.5 billion charge for H20 excess inventory and purchase obligations.
That is the price of geopolitical volatility written right there on a balance sheet.
It is.
$4.5 billion. That's like wiping out 14% of their Q3 net income.
Yeah.
What specifically triggered that financial shockwave?
It was a U.S. government requirement that kicked in April 2025. It required a specific license to export their H20 product into the China market.
And that just killed demand overnight.
Instantly. They had all this stock and all these commitments based on the old rules. And now, even though the U.S. government did grant some licenses back in August, the revenue from that has been tiny, like $50 million. It just shows how fragile their whole global operation is to political decisions.
That's a colossal immediate risk. And it gets compounded when you look at their future financial commitments. I mean, they're betting the company on being able to execute these long-term deals.
They're betting everything. Total manufacturing and supply agreements stand at an immense $50.3 billion, mostly paid through fiscal year 27.
And that's not all.
No. On top of that, they're locked into multi-year cloud service agreements for their own R&D and their DGX cloud service. That's another $26 billion through 2031.
So they're just buying up all the future production and cloud capacity they can get their hands on.
They have to. It's the only way they can guarantee they can deliver on that $500 billion in committed revenue.
And this spending shows they know that constraints aren't just technical anymore, right? They're logistical. They even mentioned pushing for more U.S.-based manufacturing.
They do, but they put a huge risk flag on that, too. They explicitly state that it all depends on the domestic ecosystem's ability to ramp up production in time. And the 10Q goes further. It talks about resource scarcity, challenges to future revenue, including the availability of data centers, of energy, and just the capital for their customers to build this stuff. They specifically call out energy capacity as a complex, multi-year problem that could easily bottleneck their growth.
And the geopolitical friction isn't just coming from the U.S. side. They're getting squeezed from the other side, too.
It's a tightrope walk. You have these dual political risks. First, the U.S. Senate passed the GAIN AI Act in October. That could restrict the administration's ability to adapt export rules, making things even more volatile.
And on the other side,
the Chinese government published a preliminary finding in September, saying that the company's compliance with U.S. export controls discriminated against its customers and violated the terms of the old Mellanox acquisition.
So they're being accused of not complying enough by the U.S. and complying too much by China.
That's the impossible position they're in.
Okay, let's shift gears for our last section and look at how they're using all the cash this generates. They're sitting on total liquidity of over $60 billion.
And that firepower lets them play both offense and defense at the same time. The defense is the capital return program. I mean, they've already spent nearly $37 billion on share buybacks in just 9 months.
And they're not done.
Not even close.
What?
The board approved another $60 billion in repurchase authorization, bringing the total program to $62.2 billion.
So huge amounts of money going back to shareholders. But at the same time, they're making these massive strategic bets on the future of the AI ecosystem itself.
Exactly. That's the offense. Total investment commitments are already at $6.5 billion. That includes a $5 billion investment in Intel, which is still pending regulatory approval. They also have a letter of intent to potentially invest in OpenAI.
And then there's the biggest bet of all, the investment in OpenAI's main competitor, Anthropic.
That's the big headline-grabbing hedge. In November, they committed to investing up to $10 billion in Anthropic.
So what's the strategy there?
It's diversification. They're hedging their bets on which AI developer or which model architecture will ultimately win. By investing in Anthropic and OpenAI and Intel, they're ensuring that no matter which software stack comes out on top,
Their hardware, their core infrastructure is indispensable.
exactly, they're capturing value across the entire ecosystem.
Now, before we wrap up, we should quickly touch on that long-running shadow, the securities class action lawsuit tied to the crypto mining issues from years ago.
Yeah, that risk is still there. The lawsuit was sent back to the district court in February 2025 after the Supreme Court dismissed it. So while it's not an operational distraction day-to-day, it is a significant old financial risk that's moving forward again in the courts.
This has been a really exhaustive deep dive. To just quickly summarize for everyone, we've looked at a company executing this incredibly high-stakes transition to Blackwell, hitting an unprecedented scale, $57 billion in a quarter, all while having to absorb huge costs like that $4.5 billion inventory charge from geopolitical friction.
And I think the overarching takeaway for you, the listener, is this. The company's future success, say, over the next 5 years, it's not really a question of engineering. They've clearly got that down. It's a question of execution risk.
Right.
Can they actually manage over $80 billion in combined forward commitment supply, manufacturing, cloud, strategic investments? And maybe even tougher, can they navigate the political volatility and the very real resource constraints like energy that are now the ultimate ceiling on their growth?
So the limiting factor isn't the tech anymore.
It's the world's ability to build the infrastructure fast enough to catch up to the technology.
A perfect way to frame the challenges ahead. Thank you for joining us for this deep dive.